Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are, and it's a lovely Friday in Vancouver.
Bob, you love to answer listener questions, and we have several once again this week. The first one is from I say Cecil, you say Cecil.
Maybe Cecil will give us the pronunciation, I hope, on another question.
Because Caton, who likes to send us questions, told us it's pronounced Caton.
Yeah, okay.
Cecil writes, "Hi guys, love the show. A question for Bob. Why can't they just keep blowing the financial bubble bigger, 1, 2, or even 5 times more, with more money printing or Fed money tricks? Even if we get a pullback of, say, 20%, why can't they just keep supporting the markets and push everything up? That's the reason why this will fail soon. Why won't they just keep doing it? They won't fail. And is there a way to tell them that that is actually what they should do?"
Right, yeah, and okay, this is pretty standard notion that that all the Fed needs to do to keep a boom going is to yet provide more credit to the markets. And but history now, if that was true, it would be one non-stop, uninterrupted bull market since the Fed was formed in 1913. But we want to go into a little more detail on the Fed, and that was when it was being promoted. The original promoters, of course, at that time, most knew that when you had a credit crisis, it would be followed by a recession. I mean, that's been on since the 1500s. So then the theory was that the Fed would be lender of last resort and come in with the necessary liquidity, and there would be no credit crisis, and there would be no recessions. But since the Fed opened its doors for mischief in January 1914, there's been 18 cyclical recessions. So, and all it takes is one to disprove the theory. So what one wants to look at to understand why the theory doesn't work in practice. And it's because in a financial mania, the street can create whatever credit is needed through leverage on rising prices. And then whenever that happens, everybody's in the glue, so to speak, and all it needs is a downtick in prices, and the whole thing starts to come apart. And so where during the boom, most have great faith in the powers of the central bank to keep the boom going, but it's never happened. And the reason why it doesn't happen is because it's not just one bank or entity in trouble. It's everybody, so to speak. So then what happens is the power shifts over to the margin clerks at the brokerages or the equivalent at trust companies or real estate or whatever. And so I'm just sticking with financial history. And, there's another nuance to this, Jim, is that there have been times when the senior central bank, the Bank of England, was on a gold standard and relatively disciplined, but you had the same thing. You had fabulous bull markets that went up, and they crashed. It's that it does. The theory is there, but it doesn't work. So the irony is that it hinges upon that the street can create whatever credit it needs. It doesn't need the Fed to create credit on the way up, and that shows up with money velocity expanding, going up, whatever you want to call it. And then once the bubble's over, then velocity declines, and it undoes whatever attempts the Fed makes to reignite the stock speculation. So velocity shows that, one, the Fed isn't needed on the way up. Two, velocity in crashing shows that the Fed can't do anything on the way down. And there's a lovely quote from an editorial in in Barron's from 1932, which was at the worst of the first crash, and it pointed out that every anti-deflationary measure taken by the Fed is seen not to work. That's paraphrased because I don't have the exact quote in front of me. And it mentioned that the anti-deflationary measure was buying bonds out of the market. So it didn't work in 1929, it didn't work in 1873, and it won't work this time. So what we want to watch now is we had party time. Back in January, we called for party time in all the games right out to about mid-year. And then August could have been a transition month where some of the forces changed that would be then acting against the bubble. These would be some key commodities no longer going up, which is the case. It would be credit spreads turning to widening, which has been the case. It would be the U.S. dollar stabilizing, which has been the case. And so, indeed, August did see some items that would say that the history is transitioning into a post-bubble contraction. And even this week, I don't see anything that would change that conclusion. So still on the case that with this kind of a party, a contraction is inevitable. The question is, when does the contraction become acute? And we will soon know that. But thanks for the question.
Our second question comes from Justin in Berkeley, California. Is there any other Berkeley that you know of, Bob? I think Berkeley is Berkeley.
Berkeley's Berkeley.
Justin writes, "Hi, Bob and Jim. Once again, there are claims we're going into hyperinflation because the late 70s conceptual evidence shows that with printing in excess, you get high lending rates and mistrust on the return of investment. A lot of the high rate blame or credit went to Paul Volcker, who took the punch bowl away, but the chart showed rates were going up years before Volcker took over the Fed. If the dollar was going to depreciate as badly as it did in the 70s, wouldn't that mean any lending rate would be increasing? And wouldn't that also mean savings account rates for CD or CDs would be better than the current near zero rates that we have today? So isn't that empirical evidence to say that we are not in the 1970s? And lastly, even Volcker looks like he was following the private rate momentum. Isn't this what Bob says all the time anyway? The Fed cannot control long-term rates.
Yeah, you got that one right. But also, it's an opportunity to say something about Volcker. And I've written an essay quite a few years ago that he did not end the inflation that roared through the 1970s, reaching its highest in 1980. That was just a replica of the inflation that roared through the 19-teens and reached its high in 1920, and that was associated with the war. So what happened is that if Volcker had really tightened to end inflation, M2 money expansion there would have been a dent in the chart. But no, M2 kept expanding. He did. So in retrospect, what happened was that the global mania in commodities blew out, reached a climax, crashed, and then it set up in 1982 the beginning of this era of inflation in financial assets. And I can go back like 1920. It was a global boom in commodities. And in the U.S., the rate of CPI inflation got up to 24%. In 1980, it got to 14 or 15%, and the world went crazy. And then in the hit to in the early 80s, the rate of inflation got down to zero for a while. But in going back to 1920, it had reached plus 24. In the 1921, it was minus 16%. So then the Fed was very concerned about deflation, and through the 1920s was easier in money supply than it would have been, and then not understanding that the money was going into speculation in financial assets. And here we are, the last decade of Fed policy, is they decided there wasn't enough inflation and they had to provide extra credit, which of course goes into the popular game, which has been inflation in financial assets. And all I know is that when each great inflation in financial assets completes, it's followed by deflation in most asset prices. And I see no reason to change that. And Justin, thanks for your question.
Our third question comes from David, and it couldn't be more timely, and we'll tell you right after the break why. David's question: Bob, what's your opinion on Bitcoin and cryptos? Are they in a bubble or a top now? Are they important to invest in? Will they be important in 10 years? Thanks for the great show, guys.
David, nice view on that. A month or so ago, I did a short piece on crypto and Bitcoin and pointed out that it was more speculation than reality, and that the problem within it is that it costs huge amounts of energy and huge amounts of money to create, let's call it a token, let's call it a share certificate, let's call it a bond certificate, in order to speculate with. And it's and you've had price gains on large cap items that has exceeded anything in history. Sure, you can get a junior stock in the Vancouver market going from mere pennies to $7, which is immense, but I'm talking about big cap stuff. So it's been extraordinary. Now, China, for whatever its reason, the policymakers have moved to dampen speculation, and in the case of Evergrande, which we talk about frequently, they just ran out of the ability to borrow, and so that's in a classic contraction. But also it's fascinating that the Chinese are turning to quell the speculation in crypto. I don't think government should be moving to favor one industry or disfavor another industry. But hey, it's going to be interesting, and the crypto has been remarkable, and there have been remarkable items in bubbles in the past, and they have crashed. So it's worth watching, and thanks for the question.
And China has just banned cryptocurrency transactions. They say from now on they'll consider them criminal. Bitcoin has fallen 8% on that news. Bob, cryptos, once again, no assets to back them. They're pure speculation. Are they still going to stick around, or we don't really need China? The rest of the planet will deal with it.
No, the sectors, like everything else that's hot in the bubble, will get hit. But underneath it all, I think there's been some remarkable developments with cryptos, and at some time, somebody can create a currency, a real currency out of it that has relatively constant value. which is what the world needs. It used to be that the senior currency was convertible into gold. And indeed, at one time, most important countries, their currency was convertible into gold. And that is the best you can do on providing a currency of constant value. And you can't even get a constant value out of a convertible currency, but you can, it's the best we can do. So somewhere out there, out of all of the madness in cryptos, there will be something good come out of it, I think, at some time. So it'd be interesting to watch.
Well, El Salvador now accepts Bitcoin for official payment, and the sign that it's official, it will accept tax payments in Bitcoin. And Cuba says it's going to start officially recognizing and regulating cryptos as a way to get around American sanctions.
Oh, possible. El Salvador, I think, had a good system where their currency was based upon the U.S. dollar. And going to this, I don't know. It's all part of the madness out there. So, and as far as Cuba, whatever they do is going to be crazy anyway. So.
Well, they always tell you to bring toothpaste, extra toothpaste, toothbrushes, and cleaning supplies because people would rather be paid in those things than actual money.
Oh, right, yeah. Or it reminds me of communists in Eastern Europe where the quip was by the workers, oh, they pretend to pay us and we pretend to work.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, the Evergrande crisis won't go away. The Chinese government has said they're confident that Evergrande will be able to meet its interest payments, which is probably, if you can't pay down the capital, you're still in trouble, I think.
Yeah, no, there's no fixing it. It's just very big, and in the past, there have been things that have been too big to fail, and one I looked up the other day was in London, and the great financial bubble that peaked in 1825 was a huge one. And then, of course, in the fall, when it was beginning to contract, there was a very important, a top-quality broker called Poole and Company. This is to be distinctive from then also the merchant banks. But anyways, it was a very important broker. And, of course, with the contraction, they were offside. And the Bank of England was looking at it and figured it couldn't allow this huge broker to fail. It was too big to fail. And in the days or week that it took to get moving on it, the market continued to crash, and then it was absolutely hopeless. So the too big to fail story, the financial forces in the contraction have overwhelmed that story, and that's one instant of it. And I think it will overwhelm the Evergrande story as well. But there's also part of a pattern in here, Jim, where in March there was kind of a setback in the markets and the dollar firmed up, and that was on reports that South Africa, Argentina, and Turkey, their central banks were running out of liquidity, so they had a little domestic crisis there. And we've noted that in the past, when you're in a wildly speculative market, that the problems will appear in lesser countries, and indeed it has. But then, and of course, I think the whole of the stories coming out of China is that they are having a crisis similar to Turkey. And then also I saw a headline just the other day. It was about Argentina, I think, not being... Argentina bonds fall. So in previous bubble years, the problems are discovered in lesser countries early in the year, and they continue to happen, and they then become compelling and spread around, and then finally hit the financial center in the fall. Decades ago, it was London. And in the 1873 crash, London looked at New York and said, the problem is in this dreadfully speculative New York market, and it's causing the problem. And so that was a classic, and here we have now the pressures are arriving at New York. You've had, the steps are in place on the path to a contraction, and there's just a couple of lines in the sand that we're watching here before it becomes exciting. So, and as I say, it's a classic pattern, Jim. Problems in lesser or outlying countries, then hitting the senior markets in the fall of the year. And actually, this pattern goes back 2,000 years ago when the Roman writer Cicero wrote that when there was a financial problem in the eastern provinces, meaning Phoenicia and whatnot at the eastern end of the Mediterranean, that it would inevitably hit Rome. So what we're seeing now has been going on for thousands of years. And the irony is that policymakers don't know that this pattern has been going on for thousands of years, and too many people believe in the policymakers, and I think they'll be seen to fail again.
Now, the Evergrande crisis, they've given their workers an ultimatum: either lend them some cash or we'll cut your bonuses. Hell, they'll probably have really said, or we'll just cut your job.
I think so, Jim. And they're offering creditors empty apartments as compensation. They're offering creditors incompleted apartments. So, I mean, it's a staggering mess, and it will crash without a doubt.
Do you think the Chinese government will or has the resources to back Evergrande so it doesn't crash and cause a ripple effect that will hit markets around the planet?
Yeah. Well, that's the wish. That's wishful thinking, and it has never worked in the past. As I said, I give the example of the most important broker in London in 1825 was going to be rescued, and then it wasn't. Jim, it is so profoundly amazing that you're seeing a replication of 1929 or 1873, or going all the way back to the first bubble, the South Sea bubble in 1720. That one has instruction as well, because in London you had the Bank of England on a gold standard, and you also had usury laws where they could not lend money above a certain rate. I think maybe it was 5%. Then in France, you had John Law with the Banque Royale, a sort of a government bank, and they were not on gold, and he could issue any amount of, they were actually printing currency. But their bubble was called the Mississippi bubble, and it began to fail before the South Sea bubble in England did. Now, the South Sea bubble was not accompanied by printing presses. It was just straight expansion of credit, some of it outside of the central bank. But in France, it was printing press money. And the market failed before he stopped the printing presses. And then in the crash, the public, ordinary citizens, demanded to see the printing plates for the currency. They demanded to see them destroyed. It was such an evil situation. So, hey, in Paris you had 8 printing presses going, and the market failed before the printing presses were turned off. So that's an instruction, I think. So, no, I think they will, attempt and are attempting to keep the bubble going, China is, I think, in their view, acting wisely in slowing the bubble and hoping that that may prevent a crash. But I think you're going to get a crash in China anyways. So, interesting times, Jim.
Well, Wall Street says it believes the Chinese government can bail them out.
Yeah, that was another headline.
Yeah.
Well, that's what they believed in 1929 as well. John Moody, of a firm that is since known as Moody's, he wrote an essay late in that boom, and he pointed out that nothing could go wrong because the old and dreadful national banking system was gone, and it was replaced by a modern and scientific Federal Reserve system. And, of course, it went wrong. Now, then we want to go back to the 1873 bubble, where in New York, the important newspaper, the Herald, in the summer of 1873, published an editorial that pointed out that nothing could go wrong because the U.S. did not have a central bank. I'm going to repeat that. Did not have a central bank. They didn't have a central bank. They had the Treasury or national banking system, and not on a gold standard. So then the Treasury could issue unlimited amounts of credit to prevent a contraction. And the market in New York peaked in that fateful September, then crashed in October, and the contraction in the weak economy, the senior economy then was England, and with general weakness prevailing since 1873, economists in England in 1884 began calling it the Great Depression, and it lasted till 1895. So we've seen this before. Also in 1873, I'll go on more, Jim, is when the esteemed editor of The Economist, Walter Bagehot, he published a book on how the financial markets worked called Lombard Street, and in it he pointed out that a credit crisis was sort of a neuralgia. It need not happen, and indeed the Bank of England, in stepping in and providing liberal amounts of liquidity, would prevent recessions. And indeed that was published in the year 1873, and then England suffered a Great Depression from 1873 to 1895. So all of these theories have been ventured many times by naive intellectuals, and they have never worked. So all I can say, Jim, in wrapping this up, is that the financial events through August seem to be marking the transition to a potential contraction.
Bob, thank you so much for chatting with us.
Good to be with you, Jim, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He loves to answer your questions. You can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.